Hi everyone. In this tutorial, we'll be covering the capital allocation line. There are three sections within this video. First, we will begin with explaining what the capital allocation line is. Next, we will discuss its formula. And finally, we'll compare it to the capital market line. There are thumbnails in the video description, so if you would like to jump ahead, feel free to do so. Okay, so let's get started with explaining what capital allocation line is. It's really a simple idea. So we need to look at the risk return space. So we have risk in the horizontal axis, and we will measure this with a standard deviation of returns or volatility. And we have return in the vertical axis. And this could be either expected return, if we are making forecasting, so it's forward-looking, or it could be historical return as well, in terms of performance evaluation, right? Capital allocation line basically tells us how to split our funds between two assets, one of which is going to be a risky asset and the other one a risk-free asset. So let's begin with the risk-free asset. So let's say we have a risky asset A over here. So this could be, for example, a single stock, right? Or it could be also a portfolio of stocks. Doesn't really matter. But important thing is that it is a risky asset. So this is our first point. Our second point is going to be risk-free asset, right? And this asset will yield a return of RF. So this is the risk-free rate of return. And of course, because the asset is risk-free, it has no risk. So standard deviation will be equal to 0. So basically, capital allocation line is the line that connects these 2 points. Okay, simple as that. All right, so let's next talk about the formula of the capital allocation line. So it should, of course, fit the general equation of a line, right? So the general equation of a line looks something like this. So we have y equals to an intercept, so let's call it c, plus slope times x. So this is the general equation of a line. Now we need to make that fit into our situation, right? So first of all, what is going to be our intercept, right? So that's easy to see. The intercept is going to be the risk-free rate. How about the slope? So the slope of this line, we can basically focus on these 2 points. So for example, we have our risky asset here, A. So it will have a volatility of sigma A and the return of RA. And the slope of this line is essentially this vertical distance divided by this horizontal distance, right? The steeper the line, the higher will be its slope. So the vertical distance is RA minus RF. So this is going to be the numerator of the slope. How about the denominator? It's going to be sigma A minus 0. So it's simply sigma A. So this is the slope. Now, basically, I've got the intercept, I've got the slope. Final thing is to understand what are our x and y variables. So in this scenario, it will be any portfolio, let's call that P, that will be a combination of the risk-free rate and our risky asset A. So any portfolio will have a risk of sigma P. So I'm just going to call this portfolio P. And its return will be essentially equal to this right-hand side, right? So this is the equation of the capital allocation line. So you got the intercept, the slope, okay? And to understand it a bit better, think of, for example, a portfolio here. So let's suppose P is over here. So this is more or less equidistant to the risk-free asset and our risky asset A. So this portfolio is more or less investing 50% of the funds in the risk-free asset and 50% of the funds in the risky asset A, right? Or P could be somewhere over here, right? How would that work? So, for example, this could be 50% A, 50% risk-free asset. Let's say RF. How about this one? In this case, essentially, I am borrowing at the risk-free rate to invest more in A. So this could be a point, something like, 130% in A and minus 30% in risk-free rate. So I have a short position in the risk-free rate, which is the same thing as borrowing funds to invest more in asset A. So let's imagine you have initially $100. If you borrow $30, right, you can invest in total $130 in A, right? So this is how capital allocation line works. And the last thing I would like to discuss is the difference between this capital allocation line and the capital market line. So to illustrate that, just let me draw again this graph, right? We have risk on the horizontal axis and return on the vertical axis. Now, in financial markets, there are many risky assets, not just one, right? So I can combine, so let's say the risk-free rate is over here. I can combine, so this is RF, it with any risky asset to obtain a capital allocation line. So let's say with this one, just to make it easy. So let's call this A, right? So this is a capital allocation line. Capital market line is a specific capital allocation line where I am combining the risk-free rate with the market portfolio. Okay? Let's call that M, right? And market portfolio is a very specific portfolio. So let's make it a bit more explicit. Market portfolio. This is a value-weighted portfolio of all risky assets, right? So all the points you see over here will be in the market portfolio, right? And it's value-weighted. Now, this line is a capital allocation line, okay? And I can draw many of them. But there is one unique capital market line, which is the line that connects the risk-free rate to the market portfolio. So that is the distinction between CAL and CML. All right, so this is all I would like to cover in this video. I hope you have found it useful. See you in the next video. Thank you for watching.